Okay, welcome everybody back to the Today's Market Explained podcast, a FourStar podcast. Once again, I'm Brian Castle. I'm your host, and I'm here with Mr. Christopher Reardon. Chris, my co-host, welcome, sir.
Thanks, Brian. Glad to be here. Glad to talk a little bit about markets.
Well, and Chris, of course, is our director of development, managing all the research and investment management processes of the firm and marketing and anything product related. Chris does a great job. So he runs that whole program for FourStar and has great insights on the markets as he tracks everything closely and works with all the trading. So Chris, great to have you here.
Thanks.
And of course, I'm CEO and founder of FourStar. I'm Eagle Scout, trustee of the National Boy Scout Foundation, philanthropic advisor, CEO advisor as well. But I'm the chief dad to Quinn and Evan and husband to the amazing Tripty. If you like what you're hearing today, we just want to remind you to give us a 5 out of 5 ranking on Apple iTunes. The more 5 out of 5s that we get, the more notice we get and the better the podcast does. And then you might be seeing this in video form as well on TikTok, Instagram, and all the other services. So we are going to do our standard process today. We'll talk about the markets, the economy, and then generally what we see out there. So Chris, it's been a really wild couple weeks in the market. We had 7 down weeks and then 1 big up week. Where does that leave us on these tally scores that we track all the major asset classes, Chris?
Yeah, Bryce. So we still have commodities leading the way in the number 1 position. It's actually flat since the last podcast. It's funny. It did rally up and then kind of came right back down to this 313 tally point position it's at. Cash is in the number 2 position. It gained 9 points and it's at 193. So it is firming up in that number 2 position. So 1 being commodities, 2 being cash. Domestic equities in the 3rd position lost 21 points since the last podcast. It's sitting at 170 right now. So it continues to deteriorate in that 3rd position, while international equities lost 18 and it's at 158 in the 4th position now. So it's deteriorating as well, but a little slower, but still deteriorating significantly. Fixed income is in the 5th position. It gained 16 points. It's at 152. So potentially we could see, if these trends continue, fixed income take over in that 4th position and see international equities drop to the 5th position potentially. And then in last is currencies. It gained 12 points and it's at 105 tally points. So a lot of change. I mean, the movement that occurred is really what we've been consistently seeing, which is really domestic and international moving downwards. Cash obviously had that big jump upwards in the last month that we saw to vault it into that 2 position. But fixed income and currencies as well have been, for the most part, gaining as well. So it's been pretty consistent.
So that's interesting, Chris, and just the thought process here. Commodities being number 1, and that can go on for a period of time. But if commodities are number 1 for a long time, commodities are an input cost to business and to consumers. So that's not a positive long term. Short run, of course, any investor can make money on different commodities. But so while commodities are in the number 1 position, we're in a kind of a weaker phase. Cash is up there. It looks like fixed income and currencies are close to overtaking U.S. stocks and international. That within striking distance, like 1 week's change could change all that. And then we're in full on bear market mode. Usually the bear market mode is commodities, fixed income, cash, and currencies in the top 3 and 4 positions.
Yep. Yeah. I mean, I think that would be a good description kind of what we're seeing here. I mean, I think we could easily see fixed income this week, depending on how the markets act, and then currencies could easily follow in a week or 2 with where they're at now. So, but yeah, the trend there would definitely be more of a bear market.
Yeah. So we're not quite in full-blown bear market yet. We're in a bear market, but about half the bear markets that go north of 20% down end right around here, and half go much lower, 40 to 50%. In the 2008 went down 58%. The 1970s was the worst bear market in recorded history. That went down 70+% from the high. even worse than the Depression market in the 1930s. So we'll see how it all shakes out. Well, thanks, Chris, for the update. We had a big week last week, a big up week, 5-6% in all the indexes, which was a bounce off the bottom, which closed the previous Friday before that at recent lows. But then it rallied on very light volume, and it rallied all the things that weren't working in the collapse started working again on light volume. So that's kind of a feeling that it's a reaction, and kind of a pop, but not a real serious rally. But then later in the week, it looked like a little bit more buying. It looked a little bit more serious than earlier in the week, but still not enough to say, hey, this is really a bottom, right?
Yeah. I mean, I think that one thing to consider, I mean, it was obviously a big week up, 5-6%. But there's a kind of an anecdote in the markets that, the strongest up weeks usually happen in bear markets when the markets go down. So that wouldn't be necessarily uncommon for, a downward market. You do see pops, people get exhausted of selling. But, I think with what we see, like you said, Brian, the light volume kind of increasing towards the end. And then to kind of start this week, we've seen a little bit more of downward movement a little bit. I think that, I don't know if we've necessarily hit the bottom yet. We haven't seen that yet, I should say.
Yeah, look, and I will talk a little bit further about that in a second. But, when I'm trying to remember back to the bull market history, how often have we seen a 5 or 6% up move in the market in a bull market? Not very often, if I can remember any.
No. I mean, it's very rare. I mean, 5 or 6% moves are rare in and of themselves. I mean, those weeks, and we've had a couple in May. We had a couple, or at least one in May. So in the last 2 months, we've seen at least a couple 5 or 6% up weeks, which is pretty crazy.
So we're in a bear market and everybody's a little shell shocked, right? Because their portfolio's down. So we have a big 5 or 6% up move, and everybody's like, yeah, okay, that's kind of normal. Well, it isn't kind of normal. I mean, at all. We don't get those kind of moves in bull markets. So we have a big up move price wise, and everybody's like, okay, all right, fine. But they don't see it as unusual. It's quite unusual and only happens in bear markets. But then if it doesn't really confirm with more strong volume, going through naturally, this Monday, the market was fading a little bit. Then today we had a big up move on the open. This is Tuesday the 28th. But now it's down as the market is reacting to some other numbers too that came through, consumer sentiment numbers, right, Chris?
Yep. Yeah, some weakening numbers there. The market's kind of rolling over a little bit on some of the economic numbers.
Right. So now going into the 4th of July week, which is coming up, is often positive. If there's less people involved in the market, so the market could rise on light volume. Today's Tuesday, probably by Thursday, people who are leaving are going to go. So there's less people involved. And then all next week, so it's a 4-day week after 4th of July, there will probably be less players in the markets. So volume might be light for a while. And then the following week is probably a more determinative week. The week, I guess, that would be of the 11th of July. We'll see what things happen then. Interestingly enough, one of the recent bear and correctly bear investors, Mike Wilson, chief strategist at Morgan Stanley, said from here they're expecting another maybe 7 to 8% rise, and then further down and break the lows. And we wanted to explore that, So if we don't see a big move on strong volume here, then there's the likelihood that we do go lower. And as we see a light volume rally in 1 week after the market collapsed, after a 7-week collapse, that's not a confirming signal that the market's a bottom. Then if we don't see any real strong moves upward from here on strong volume, then that would probably tell us that the market's going to go lower. The odds are, based on the economic flow, that we do go lower. So we want to be real clear about this, though, Chris, we're not predicting that. We're not hoping for it. We don't want the market to go lower, but we're just saying, this is what we think is possible here. And so investors have to get themselves in a position where they're not so panicked if the markets go lower. One of the processes people go through in a market like this is they first of all think, oh, it'll be short-lived. Then there's fear. Then there's panic. Then there's reaction, and that's usually kind of when the bull market and the bear market really hits stride, when people are panicking and selling and things like that. We haven't seen a lot of that. We've seen a lot of frayed nerves, but no real panic selling. So that may be the next step to come. So we'll see. But there's this process you go through in a bear market until all the sellers are gone. The markets don't see a lot of upside, and it appears that way right now. So again, we would be thrilled that prediction is wrong. We're not invested in that prediction, but based on what we're seeing, it looks like the market probably will still turn over and go lower.
Yep. Yeah, that's the trend we're seeing right now. I think, obviously each week we're getting new data, new information, the markets change. So that could change. We hope it does change. But, with what we're seeing now, we're taking the proper actions on our end, and, we play it week by week.
Well, and let me explain for investors what our process has been. For those who have not heard the previous podcast, is we have 4 different positions that we go from maximum invested to maximum cash. And in 2 cases, portfolios that's 100% cash, and 2 that's 50% cash, and that's the maximum position in those portfolios. And that's where we are right now. Now, if we started to get more evidence, Chris, price-wise, just for the information of our listeners and viewers, that we would start to move money back into markets in 4 different moves. It's evidence-based. We get some evidence, we get some signals turning positive, then we'll move a quarter of the money in, then a half, then 3/4, and then get fully invested 4 out of 4. But it's a process of weeks and months, not days, usually, right?
Yeah.
So we haven't anything yet. Now we could have another week of rally, and we might get our first signal, and then we would be essentially obligated to get in, because we're not sure if that signal is a correct signal or not. And if for some reason that's the incorrect signal, we'll retrench and get that position back out, and hopefully maybe take a profit, but it might be a little bit of a loss as well. But it would be less of a loss than if it went a lot lower. So that's how we'll play this. In March, we had a 14% rally off the bottom, and we did go to position 1, getting back in, and then we had to retrench. That might happen here again. We don't know. We don't really know. But even in the 2020 market, it was the sharpest 35% decline and the sharpest recovery all the way back up to the top in the same year because of the pandemic crash. And it still took about 2 months to get back in completely into the market. So it'll probably, even if we bottomed 2 weeks ago, it'll probably be till mid to late summer before we would be fully invested. Right.
Yep. Yeah.
So what we're looking for is now we have a rally. We're looking for that rally to hold, so a higher low, and then break to a higher high. So higher highs and higher lows are the evidence that then turn signals to signal that actually the market has bottomed. But if we break to new lows, well, then that's a non-confirming signal, and then we would just stay defensive and wait till the market found its bottom. And then from whatever bottom it finds, way down there, wherever it goes, then it will start to do that same pattern I just spoke about. It would rally, hold that low, rally again, break the previous high. So again, higher highs and higher lows. Bear markets are characterized by lower highs and lower lows. And right now, that's where we are. All the lows have been lower and all the highs have been lower. Right?
Yeah, no, I mean, it's definitely been, if you pull up, I mean, for any of the listeners out there, if you just pull up a chart of really the S&P 500, I mean, you can clearly see kind of the trend we're talking about, where we're seeing these kind of lower lows. So, we'd like to see that bottom and kind of start that process, like Brian said, of higher highs and kind of start an upward trend.
Right. And there's so many aspects to an economy. We have the war going on in Ukraine still. We've got Russia defaulting on debt. We have all kinds of really interesting geopolitical and economic stories. There's still parts of the economy that are recovering from the pandemic, like supply chain issues and things like that. So it's such a complex thing that anyone who says they know exactly what's going to happen will probably lie about other things, because there's no possible way that you can know all the details. So while we're saying we know what we will do, we are not sure what will happen, and because no one is ever sure what will happen. So we just want to protect value on the downside, make sure we're not losing a lot of money in a bear market. Then when risk is being rewarded, meaning it's clear the markets are rising, well, then we want to push all of our chips back onto the table and then take risk at that time, but not until we're certain that the markets are better and starting to grow again. The standard process, the standard position for financial markets over history, over time, is to rise over time. They always rise over time. But it's these bear markets that you can get caught, lose a lot of money, that are very, very detrimental to investors. So we want to be very defensive in those periods of time, and then fully invested to try to beat markets when things are rising. Chris, speaking about the economy, there are a lot of kind of controversial decisions being made and a lot of convergent numbers, right? So we have home prices up, don't we?
Yeah. So the housing market, we're getting the data now from April and May, kind of usually trails a month or two depending on the data. But the May numbers primarily are out. The median existing home price rose 14.8% in May year over year. So we continue to see in May housing prices rise. So the median price is $407,600 is the median price now for a home, which is a record high. So we continue to see prices rising. Potentially, we could see that maybe start to slow in June. Obviously, higher interest rates are going to start to choke off that market a little bit. But kind of the May numbers, we still haven't seen that deceleration as much yet. The S&P CoreLogic Case-Shiller National Home Price Index, which is just another one. This is their April number. It rose 20.4% year over year in April. And that was a slight deceleration from the March number, which was 20.6, but still obviously a very hot number. And I think one of the reasons these April and May numbers were still high or elevated is with the rising interest rate environment we were in, you had a lot of people kind of flooding to try to get locked in rates, either move, buy a new house, and get in that house before, interest rates really moved upwards. So I think we still saw kind of a flood of that towards the end of April and May. New home sales rose 10.7% in May. So we still saw positive news there in the real estate market. Pending home sales index, those rose 0.7% in May to 99.9. So, overall, the markets in April, May still look positive. Once again, that could change in June as it really starts to settle in these higher interest rates. But the April and May numbers still look positive. On the flip side of that, with the housing market still being very hot, housing prices rising, interest rates rising with that, obviously, it's making it tougher for several people to go and purchase a home. So a lot of people are turning to the rental market. Rents for single-family homes, so it's just single-family home, rose 14% year over year in April. And that was actually a 13th consecutive month that rents for single-family homes grew. So we continue, we have rising home prices, rising interest rates. A lot of people are going to the rental market, and it's tough. They're getting priced out of that as well. And then the last thing, or I guess the last two things I'll mention, orders for durable goods rose 0.7% in May, so that's positive as well. We saw big ticket items, cars, computers, military aircraft get included in there as well. So that rose. And then I think the biggest negative aspect, or the biggest negative number we've seen so far that you alluded to in the beginning, Brian, is the University of Michigan Consumer Sentiment reading. And that came out at 50 for June. And that's the lowest reading on record going back to 1952 when they started this this kind of consumer sentiment reading. And for reference, that's also down 58.4 as it was a reading in May. So I think a lot of people looked at that. I know we've talked about it, and I think even the news does a pretty picture, or talks about a lot, is the consumer is really the growth engine behind the U.S. economy. So I think a lot of people look at it and say, if we're starting to see consumer sentiment and potentially consumer spending maybe roll over, maybe we see the markets going lower. So I think that's what's driving what we're seeing today.
So we're still seeing auto prices rise as well because of supply chain. So there's a lot of divergent things, right? Certain things are going higher and certain things are not. Although if interest rates keep rising, eventually that real estate price increase will start to decelerate, then be flat, and then start to slowly go, turn down a little bit. Hopefully not a lot, but that may be a lag of a couple months before that happens, right, Chris?
Yeah. Usually, I think the last time we really saw an interest rate rising cycle like we're in now, you see it. It's almost like a sputter. You see a spike at the very end, which is kind of everyone trying to rush to buy before we have this interest rate and rising environment. And that's probably what we're seeing in these April and May numbers. I would imagine we may start to even see some of the impact in June, July, and further months.
Right. So now rising interest rates. We keep talking about the negatives. It's actually a positive, though, for the banks. And so we're looking at bank earnings looking a little better because bank margins have been crimped as interest rates were at zero and there's very little margin. So banks make more money when interest rates rise. And also, we've talked about this on the FourStar Today's Market Explained broadcast about how we had hoped the rates would be higher for savers. A lot of investors are savers, essentially, and seniors living on a fixed income. So all bond yields go up, all CD, not much, right? It's the first move, but it's starting to move a little bit. The Fed has indicated that they're planning to keep raising rates, but if things slow down quickly, they may be in a box and not be able to raise rates and worrying about really, tumbling the economy not only into a recession, very deep recession, and they want to avoid a very, very deep, depression-like recession, right? So the rates will probably continue to rise, but there may be a point where the Fed can't keep doing that, even if they want to ward off inflation. So.
Yep. Yeah, I think the rising rates are great for, like you said, Brian, banks and more conservative savers maybe. But where the rates actually hurt is people that are going out to borrow the money. So once again, in the housing market, even if you're taking a loan out to purchase a car, it hurts there. But on a larger scale, rising interest rates are starting to hit government spending. So with the current fiscal year that began in October, government spending on just interest costs alone increased by nearly 30% from the prior year. So now their interest costs are $311 billion just through May. So with this higher interest rates, as the governments put bonds out, things like that, it's going to cost them more money to take out. So that'll be interesting to see the impact that has on the budget, on deficits, things we've talked about that relate to the government spending.
We'll see how that goes. Also, the inflation, which is at record levels, legendary levels here in America, is expected to fade into next year, into 2023, but could be quite high all through the fall. And just for the record, UK inflation is up. A recent reading was up 9.2% year over year. So they're suffering from the same thing that we are. And most developed nations also are suffering from increased inflation in prices. Consumer price index. And the way it's calculated, many economists are saying it's actually higher than 9. Same thing, ours is actually higher than 8. But the way it's calculated, that's where we're coming at. So a lot of people are struggling with higher costs of goods, certainly commuters, with higher gas. Gas has almost doubled in the last year, which is really crazy. So anyway, it's very frustrating. Yeah, now, even in the last couple of weeks, we're starting to see a sharp slowdown in certain areas, like even though rents are up, sales of real estate transactions are coming now at a pace in the last couple of weeks to be actually near pandemic lows. So it's almost like if anybody remembers 9/11, when that happened, the whole country just paused for a couple of days where anything that was going on just stopped for a while as we tried to digest what happened. That's kind of what is happening. There's no disaster like an airplane hitting a tower, but economically, that's what's going on. And it seems like so many of the economic numbers that were strong have now actually turned very quickly in the last couple of weeks. And we'll see if that's just an air pocket or if that's going to be a continuing thing throughout the summer. You saw it in the sentiment number, Chris, already, that's turning down. So there's enough things turning down. Market seems to be anticipating that. If that happens in the real estate market, then that will eventually, like we talked about, lead to decelerating price increases, then flat, and then prices down. And the economy will lead to lower earnings as well. So it's kind of like a 9/11 pause. So we'll see what it looks like as we come out of the 4th of July weekend. Then that gets complicated because then economic activity usually is slower around a big holiday weekend like that anyway. But then coming into the mid-July area, we'll see what the economy looks like. So,
Yep.
So in what we see out there area, there's a lot of still pandemic effects out there. The teaching profession has taken a real beating as certain schools and certain municipalities wanted to keep their schools closed, and many wanted to keep them open and got kids right back into schools as quickly as they could. And the teaching profession, however, there was so much stress with people teaching students at home, students not achieving, masks and all the COVID issues. So 300,000 teachers since the beginning of the pandemic have left the profession. That's 3% of all teachers in America. So that's obviously pretty tragic, pretty sad. And there are certain groups like unions that are still trying to keep certain schools closed, or they react real quickly when there's a COVID outbreak, immediately wanted to close schools. I think we found that there were a lot of teachers that were, vacationing and doing other things. And so we've seen a lot of really bad behavior in that business. And it's actually, that could have long-term affect the economic prospects of people who are going through those schools. They say that, a couple of years worth of really spotty training has set a lot of students back. So we'll see. That's one of those pandemic effects that could lead to an economic effect. Also, we've seen some changes recently that with all the inflation and all the problems with the world economy slowing down, inflation hurting, we're seeing leaders falling. Macron won re-election in France, but then just recently lost parliament to the Conservative Party, Marine Le Pen's Conservative Party. So now there's some question whether the Prime Minister of France will survive for a long period of time. And then the same thing happened in Israel, where the Prime Minister had to resign because he lost a majority. And that could lead to the return of Bibi Netanyahu, the Conservative Prime Minister, who's served a number of times. I think it's 3 times already. So we'll see what happens there. And depending on the governments and their policies, obviously that affects a lot of economic activity between countries. And then, of course, Chris, there's Russia and Ukraine. And I understand Russia's defaulting.
Yeah, so this week, Russia defaulted for the first time on some of their international bonds. It's an interesting thing to note because it's more of a technical default. Russia could pay the bonds, but since a lot of the global financial system has been cutting off Russia, they have no way to pay the bond at all. So it's more of a technical reason that they can't pay it, not that they have the money to do it. So we'll see more and more of this because they just are unable to can do the financial transaction to pay the money to who they need to. But so it's one of many that's going to be coming down the pipeline. But technically, I think Moody's, one of the rating agencies, put them into default this week.
I see. Yeah, well, that's unfortunate too. The whole thing over there in Ukraine is unfortunate. And Prime Minister of Ukraine wants to end the war by year end. And I think he means he wants to win the war by year end, not end it and give up territory, because they're obviously wanting to get Russia out of there. Some interesting changes in the corporate world recently. Mondelez, which was the spinoff of Kraft, is buying Cliff Bar. So there's always some changes as companies move around. They buy companies, they intermediate companies and conglomerate into big companies, and then they back down and they disintermediate depending on how much growth they have. The markets pay for growth, and so whatever way they can get growth, either by merging together or breaking apart, they do that. Kellogg, on the other hand, Kellogg's of Battle Creek, the famous cereal company, is actually splitting into 3 companies. they've determined that most of their businesses are too slow, so they're going to make these companies smaller and try to find tuck-in acquisitions so those individual subsidiaries will grow faster.
And one more I'll add to that, Walgreens, the pharmacy retailer, for those of you who own the stock, it's Walgreens Boot Alliance is WBA is the ticker of what it's traded at. They were looking to sell off the Boots chain, UK pharmacy chain that they had acquired, but they scrapped that plan in recent weeks because they couldn't find a suitable seller that would make an adequate offer for them. So we've been having some companies that are trying to split but are unsuccessful in that aspect.
Yes. Well, and Chris, also, we saw this week a real 80s style takeover battle. So any of the old timers might remember Carl Icahn and the movie Wall Street and Gordon Gekko and all the crazy leverage buyouts that went on in the 80s. JetBlue had made an all-cash offer for Spirit, as JetBlue is very aggressive. But there must have been some bad blood there, because even though that was a pretty good offer, Spirit determined that a recent bid from Frontier with a $2 sweetener per share in cash was a better deal. And you can debate that if you look at the offers. But nonetheless, the board is recommending the Spirit deal. So because they can't formally decide and they can't deny the other deal, they have to take it to a shareholder vote, and that'll be on Thursday and June 30th. So it's like an 80s style Gordon Gekko. Anybody remembers Michael Douglas in the movie Wall Street? Just like that, right? The blue horseshoe loves something, right? So anyway, that was interesting and very colorful language and everything else. Quite an adventure. So anyway, Chris, I just wanted to point out to all our listeners on the Leadership Matrix blog post, which you can access from FourStarWealth.com. When you scroll down to the microsites, there's 4 down there. We have a couple blog posts that I thought were interesting. And then we talk about where the markets will go, and we'll go into a little bit more detail. But if the markets, if the earnings do slow down and we're flat on the S&P earnings of 220 per, for the whole index, well, then if we go down to 12 times earnings, then we're going, below 3,000 on the S&P, and we're just above 4,000 on the S&P now. So we could see the market, getting pretty weak here. So we want to make sure that people are protective. So we talk a little bit about that in that blog post. Also, we find a lot of interesting research pieces. We put one out about whether you should plan to be uncomfortable. And most of the studies have shown that if you are always comfortable in your development of your business and everything goes along in a very comfortable way, that maybe you're not trying hard enough. And so there's been some interesting surveys out there, actually including a discussion about Second City, where they're doing improv, about how all the improv actors are always a little uncomfortable because they have to make up jokes on the spot, and you have to be really innovative and very quick. That's kind of an extreme example, but when it comes to career, when it comes to just personal development, they're suggesting that maybe you should always be a little bit uncomfortable. So we have an article about that up in the blog post, and then also a separate one about mortgage rates and home sales, where mortgage rates have spiked really sharply, and that could affect home sales, Chris, as well. And then recently, Chris and I did some podcast interviews. We have a piece where we reviewed the blame game on inflation, which was a recent market commentary podcast that Chris and I did. And then we interviewed 2 really interesting characters. Chris, you remember Carter Williams on agriculture and food innovation? Carter's quite a character, and he's quite a leader and innovator in the agriculture and food business. And you've met him as well, Chris.
Yep, I have. He's a very, very interesting guy.
So that's a great interview out there. And then a gentleman from the Pacific Northwest who is a specialist in self-storage. So we talk a lot about other types of investing and alternative investing. And FourStar has a very large platform of alternative investments, providing income streams and growth. And AJ Osborne speaks to us about self-storage and how to make income streams from self-storage investing. And we have a couple self-storage programs on our alternative platform. So feel free to connect with me or Chris or your FourStar advisor to talk about how to create income streams that are not affected by this collapsing stock market.
Mhm.
Right.
Yep.
So
Yeah.
anyway, so that's I think our big story for the day. Chris, anything else you think we should cover today, or we leave it there?
I think we'll just leave it there. I think it's a good note to end on.
Well, great. As we're going into the 4th of July weekend, let's once again celebrate our independence as Americans. Back in 1776, our founding fathers created the freest, best society in the world. We still believe that. And we want to wish everybody a great 4th of July, a great American Independence weekend. So let's all wave our flags and celebrate our success as a country. So Chris, for the whole FourStar team, that Laura, Christine, Chris, of course, here in Chicago, Fred, Jack, and Kamal, and then our East Coast team, Tucker, Karen, and Brian. And now on the East Coast, we've got Tom, and on the West Coast, we've got Mitch as well. So the team is growing. We want to, for the whole FourStar team, we want to thank everybody for being with us again today. And please join us for another episode of the FourStar podcast. Feel free to go on to TikTok, LinkedIn, Instagram, and any of those sites, including Twitter. You can see some of the video clips of this podcast and some of the others that we've done. And then we also have a YouTube channel that has all the video of all of these programs as well. So thanks again for everybody for being with us. Let's have a great 4th of July weekend, and we'll leave it there until the next episode of the FourStar Today's Market Explained podcast. Thanks for being with us.